So guys, after a long time I am making this video, but today I thought it would be a good idea for me to talk about some key learning that I had from today's budget. And the learning that I'm going to share with you is not just applicable for budget, right? This learning can be applied for any big event which is going to move the market as people anticipated and which is known in advance, right? So that is a very important criteria, right? It should be known in advance. So what are those kind of events? It can be for election results, or it can be, let's say for example, an RBI event, right? Anything where people anticipate that this event is going to happen and something big is going to come out of that event, either positively or negatively. Those kind of events, the learning has to be applied. So what are those learnings? So let me just go one by one. So the number one learning is that if you are relatively new to the stock market, or if you're relatively new to trading, then you should not be trading on these days, right? That's the very, very important thing. And now I know that people, they get very excited. The media, YouTube, and all these different platforms, there are so many videos out there. There is so much information, so much buzz out there that we somehow get the feeling that if we don't trade on these days, then we are missing out, right? So there is a fear of missing out. And see, we cannot blame the media because they are doing what they are supposed to do, right? Their job is to create a buzz around an event because that's how they get their money. But the problem is that for an average trader, right? My objection is that if an average trader is waiting for some big event to happen to make money, then these big events are basically going to happen about 3 or 4 days in a whole year. So what are you going to do for the rest of the year? It's like you are waiting for a festival to eat good food, but are you not going to eat good food throughout the year, right? So you cannot have strategies designed only for these big events, right? You cannot be just waiting for these big events to come and make you money, and for the rest of the year you just have to keep waiting, right? In fact, for a professional traders, it's the other way around. Professional traders, they are active throughout the year, and on these days they tend to become a little less active, and some of them I know personally who do not like to trade at all. The reason behind this, like why exactly should we not trade, right? The reason behind that is the volatility which is there in the market is very, very high, and the swings that you will see in the market can be so high that your stop losses will get hit very frequently, right? So here, for example, you can see that this move would have hit the stop loss for people who were long, right? And again, people who saw this market coming down and they took the short trades where their stop losses got hit here. Then again, the market made one big swing, and these are all 100-point swings. These are not small swings, right? 70, 80, 100-point kind of a swings. And then again, the market came down, then market went up. So because of these violent moves, it's very hard for anybody to maintain a reasonable stop loss. Now, my second advice is that, let's say if you have been in the market for some time and you still want to trade on these days, then you have to keep your position sizes small. That's the one thing, and that's something that I did as well today, that I kept my position size small. Now, the beauty of having a smaller position size is that even if the market makes some very big move, and those big moves, you can see that this is a 100-point decline within 5 minutes and 10 minutes. You will not get shaken out of a position that easily. You will not get scared that easily, right? And even if, let's say, you are wrong, you will not lose a lot of money, right? So that is a very important advice, that if you do want to trade, keep your position sizes small. Now, my final advice is that do not take a directional view on these days up until the event is out of the way, right? Now, what does it mean? Well, it means that up until the event is out, for example, today, I took these trades, and as you can see that I initiated my trade after the budget announcements were already out, right? Now, the reason I did not initiate a trade before the finance minister started speaking is because I did not know what is going to come in that announcement, right? Something, let's say, really, really bad would have come. For example, some taxation on long-term capital gains, or some big tax increase on STT, or something which is adverse for the foreign institutional investors. I don't know what is going to come in that event which can potentially spook the market, right? Similarly, if I have taken a short position and all of a sudden there is some good news that finance minister gives out, then that can also create a big move on the upside which will hit my stop loss. So you don't want to be speculating, right? Try to react, don't speculate. And these trades that I took, again, I kept my position sizes small. And the trade that I took today was not based on any particular direction. Rather, it was based on the fall in volatility. Now, this is something which I'm sure a lot of you who are following options, you understand that after a big event is over, then the volatility falls. So I did not have any directional bias today. I just shorted call options, I shorted put options, and essentially what I did was I collected the premium, and then the premium fell for both call options and put options, and that made me some money, right? But if you have a directional bias that the finance minister will do this, and you buy a bunch of call options, or if you believe that something is bad is going to happen, you buy a bunch of put options, in spite of the fall that you see here, you will not see those prices stay with you for a long time, and then the premium starts to evaporate rather quickly when as soon as you see a little bit of a reversal also, right? So that is my final advice, that don't have a directional bias, rather wait for the event to be over, wait for the market to give you a clear direction, and in case it does, of course you can take a directional trade. But for me, generally speaking, I'd rather take a trade which is more based on the behavior of the options rather than my assessment of the direction, right? So these are the three key points that I want you guys to keep in mind next time when you see a big event coming, which is anticipated, highly anticipated. There is some speculation going on. So on days like this, you have to keep these three things in mind.